Hey there, and welcome to the channel. If you're new here on this channel, we explore smart investment strategies to grow your wealth and achieve financial freedom. Be sure to hit that subscribe button and turn on notifications so you never miss a video. Today, I'm excited to walk you through 8 ETFs that I'm using in my portfolio to generate monthly income. These are dividend-focused ETFs that I've carefully selected to earn me over $6,000 per month this year. I'll break down what these ETFs are, why I chose them, and how they can help build a steady income stream for your portfolio. Let's jump right in. All right. These electronically traded funds weren't just picked randomly. I used a clear set of criteria to ensure they align with my goals for income, growth, and diversification. Let's break it down. First and foremost, I focused on high-yielding ETFs. Each of these funds delivers a dividend yield in excess of 9%, providing a steady and substantial income stream. Whether you're reinvesting those dividends or using them for living expenses, this level of yield can significantly boost your cash flow. Second, I prioritized ETFs with consistent performance. While past results don't guarantee future returns, I looked for funds that have demonstrated reliability in both income generation and capital preservation. This helps ensure that my portfolio doesn't get caught in a dividend trap, where dividends are high, but only at the expense of value. Next, I set a benchmark for assets under management, or AUM, requiring at least $500 million. Larger AUM ensures these funds are well established and liquid, making it easier to trade when needed. Additionally, I focused on ETFs with relatively low fees, because, as we know, fees can eat into your returns over time. Finally, I aimed for diversification across several asset types. This portfolio isn't just about stock ETFs. It includes treasury bonds, corporate bonds, and even crypto ETFs through a Bitcoin ETF, which I believe adds an exciting layer of income potential. Diversification reduces risk and helps ensure the portfolio performs well in a variety of market conditions. Let's dive into JEPQ, the JP Morgan Nasdaq Equity Premium Income ETF. This fund has gained a lot of attention for combining exposure to the high-growth Nasdaq 100 index with a unique options income-generating strategy. But what exactly makes JEPQ stand out? Let's break it down. JEPQ primarily invests in large-cap growth stocks, found in the Nasdaq 100, while simultaneously employing an options overlay strategy. This overlay involves selling call options on the Nasdaq, generating additional income for the fund. This strategy provides investors with both growth potential and higher income compared to traditional Nasdaq tracking ETFs like QQQ. GPQ's top 10 holdings represent about 44% of its total holdings, with the largest two holdings, Apple and Nvidia, representing 14.6%. While this may be a bit top-heavy, it does cover the largest and most innovative companies in the Nasdaq and seems poised to capitalize on the artificial intelligence revolution. JEPQ was launched in May of 2022 and has an AUM of over $21 billion, reflecting strong investor confidence. The net expense of the fund is low at 0.35%. One of the key highlights of JEPQ is its impressive dividend yield. In 2024, JEPQ delivered a yield exceeding 10.7%, which is significantly higher than most growth-focused ETFs. For income-seeking investors, this makes JEPQ an excellent option. For 2024, JEPQ had a total return of 23.7%, including dividends and appreciation. By comparison, QQQ, the Invesco QQQ Trust, which tracks the Nasdaq 100 index, had a total return of 25.5%. While GPQ slightly underperformed the QQ, it is important to remember that the options strategy employed restricts upward movements, so that large up moves are limited. However, in a sideways or down market, GPQ should outperform the QQQ. This ETF carries a beta weight of 0.71, which means that it is less volatile than the market and may not rise or fall as much as the market. Additionally, JEPQ has a somewhat liquid options market, allowing investors to employ option strategies to supplement income or as a partial hedge of adverse market movements. A covered call strategy, for example, could double yields over time. As you can see, JEPQ is a strong passive income ETF, large, well-diversified, with high-yielding dividend and strong historical performance. This is one that can be the cornerstone of a dividend portfolio. Next up, let's talk about XYLD, the global S&P 500 covered call ETF. If you're looking for steady income and want exposure to some of the largest companies in the US, this ETF might be worth considering. Let me break it down for you. XYLD is designed to provide investors with income by holding a portfolio that mirrors the S&P 500 index while simultaneously selling or writing covered call options on the index. This strategy generates premium income, which is distributed to investors as dividends. It's a powerful approach for those who prioritize consistent cash flow over capital appreciation. In 2024, XYLD delivered an impressive dividend yield of 11.50%, making it a top choice for income-seeking investors. Over the course of the year, the fund distributed $4.84 per share in dividends, paid out monthly. This high yield is driven by the options premiums generated through its covered call strategy. When it comes to total return, XYLD achieved a total return of approximately 19.49% in 2024. While this is lower than the 24.89% return of SPY, the S&P 500 tracking ETF, it's important to note that XYLD is designed for income generation, not maximizing growth. This makes it ideal for those who prioritize cash flow over market-beating returns. Additionally, covered call strategies will likely outperform the index in stable market environments or even down markets. Established in 2013, the fund has an AUM of $3 billion, with an expense ratio of 0.60%. XYLD is a well-established ETF with a strong investor base. The fund holds over 500 different companies, although its top 10 list represents 37.8%. The top positions are technology-heavy, with many of the same names that you would find in the NASDAQ 100. Like GPQ, the two largest holdings are Apple and Nvidia, representing nearly 14%. While many of these names have been market leaders, the income focus limits its potential for capital appreciation compared to the underlying index. However, this does come with less volatility relative to the market, as the fund's beta is 0.65. XYLD does show an options market, but there appears to be limited liquidity and little open interest, which makes any meaningful options strategy difficult. In summary, XYLD offers a way to generate high monthly income from some of the biggest and most stable companies in the US. With its covered call strategy, attractive dividend yield, and exposure to the S&P 500, it's a great choice for income-focused investors and deserves a spot on your radar. Next up, let's talk about RYLD, the Global X Russell 2000 covered call ETF. If you're seeking steady income with exposure to small-cap stocks, this ETF might be an excellent fit for your portfolio. Let's break it down. RYLD is designed to generate income by holding a portfolio that tracks the Russell 2000 index, which includes small-cap companies from various sectors, while simultaneously selling or writing covered call options on the same index. This strategy generates additional income from premiums, which are distributed as dividends. It's an appealing approach for investors who value consistent cash flow and diversification into smaller companies. In 2024, RYLD delivered a dividend yield of 11.77%, making it one of the higher-yielding covered call ETFs in the market. Over the year, the fund distributed $1.97 per share in dividends, paid out monthly. This high yield is largely driven by the income generated through its covered call strategy on the smaller, more volatile Russell 2000 index. When it comes to performance, RYLD achieved a total return of approximately 9.38% in 2024. While this is lower than the total return of the Russell 2000 index of approximately 11%, it's important to remember that RYLD's primary goal is income generation rather than maximizing growth. Its covered call strategy can outperform during periods of sideways or declining markets. With an AUM of $1.48 billion, RYLD is a smaller but well-established fund within the Global X family. It holds the equivalent of 2,000 small-cap stocks, reflecting the composition of the Russell 2000 index. Unlike larger cap-focused ETFs like XYLD or JEPQ, RYLD's holdings are more diverse in sector representation. The fund primarily holds a sister ETF, RSSL, which provides exposure to the Russell 2000 index. However, according to the RSSL information, no single position represents more than 0.67%. The small cap stocks can be more volatile due to the inherent risk of smaller companies and can have increased sensitivity to factors such as interest rates. For RYLD, this volatility is only slightly mitigated by its covered call strategy, as the fund carries a beta of approximately 0.92, higher than its larger cap counterparts. Unlike some other covered call ETFs, RYLD's options market also shows limited liquidity and low open interest, making it challenging to implement additional option strategies effectively. RYLD provides a way to earn high monthly income while diversifying into small cap stocks. With its covered call strategy, strong dividend yield, and exposure to the Russell 2000, RYLD is a compelling choice for income-focused investors seeking small-cap exposure. While it comes with higher volatility compared to ETFs like XYLD or JEPQ, it offers the potential for higher returns and deserves consideration for those willing to take on slightly more risk. Let's take a closer look at two new innovative ETFs, QDTE and XDTE. These two funds are part of a new breed of covered call ETFs designed to offer high income and exposure to cutting-edge indices. While they share similarities in strategy, there are key differences worth exploring. Let's break it down. Both QDTE, the Roundhill Innovation 100 DTE Covered Call Strategy ETF, and XDTE, the Roundhill S&P 500 DTE Covered Call Strategy ETF, employ a synthetic covered call strategy. This means they hold positions designed to replicate their respective indices while writing or selling 0 days to expiration, 0 DTE call options, to generate additional income. These funds are tailored for income-focused investors seeking consistent cash flow alongside market exposure. These funds will sell, each trading day, a covered call against its position in the index seeking to generate options income. Daily returns will be capped at the sold strike price. However, during the overnight session, the funds no longer hold any short option positions, resulting in full exposure to the index. Each of these funds offers high-frequency dividends paying out weekly. QDTE launched on March 7, 2024, and paid a total of $11.60 per share in 2024, or about 22 cents per share weekly. With a recent closing price of $39.41, this would equate to a 29% dividend return. Looking at the total returns for 2024 considering both dividends and stock price changes, the total return was 11.3%. By comparison, the QQQ, Invesco's NASDAQ 100 fund, had a total return of 15.29% over the same period. Similarly, XDTE also launched on March 7, 2024. It paid a total of $10.73 per share in 2024, with an average of 25 cents weekly. With its recent price of $49.39, this would equate to a dividend return of 26% return. From inception to year-end, the total return for this fund was 16%. Over the same period, SPY, the SPDRS and P500 ETF Trust, returned 15.2%. Here's where these two ETFs differ. QDTE focuses on the Innovation 100 Index, providing exposure to innovative, high-growth companies. This focus offers higher growth potential during market rallies, but may also introduce more volatility. The Innovation 100 Index is a globally recognized index that tracks the performance of the largest non-financial companies listed on the NASDAQ stock market. The components of this index are weighted based on market capitalization and IT-heavy with top holdings such as Apple, Microsoft, and Nvidia. XDTE, on the other hand, tracks the S&P 500 index, offering a more diversified approach with exposure to a broader range of large-cap U.S. companies. Although this index is also tech-heavy with Apple, Microsoft, Nvidia, Amazon, Google, Meta, and Tesla, in the top positions representing over 33% of the index. XDTE does represent more diversification compared to QDTE, which will typically result in lower volatility. The funds have over $1 billion in AUM combined, with QDTE at $687 million and XDTE at $314 million. The net expense are on the high side at 0.95%, although given the active management required with daily options and weekly dividends, it seems appropriate. There are no options available for these securities. These two ETFs, while they are still in the early stages with less than 12 months of performance, seem well positioned to excel with weekly dividends. I like these because as markets decrease, volatility often will increase. Increased volatility means higher premiums, which could offset downward movements a bit more. Additionally, I like the opportunity to have some participation in upward movements that occur overnight. This is unique to this strategy that could help in strong bull markets. These high-yielding EFTs are certainly worthy of consideration for investors seeking passive income and willing to take the risk of a new fund. Okay, next up we dive into TLTW, the iShares 20-plus year Treasury Bond Buy Right Strategy ETF. If you're looking for income paired with exposure to long-term U.S. Treasuries, this ETF offers a compelling solution. Let me explain how it works and why it might deserve a spot in your portfolio. TLTW combines two components. 1. A portfolio of 20-plus year U.S. Treasury bonds, providing exposure to long-term government debt through the ETF, TLT, and 2. A covered call strategy, where the fund sells call options on the same bonds to generate additional income. This buy-right approach is designed to enhance yield, making TLTW a great choice for income-focused investors. This fund began in August of 2022 and has over $900 million in AUM with an expense ratio of 0.35%. TLTW holdings include essentially one asset, TLT. TLTW sells covered calls approximately 1 month in duration and pays a monthly dividend that includes the TLT monthly dividend plus collected option premiums. In 2024, TLTW delivered a dividend yield of 14.67%, distributing approximately $3.40 per share over the year. These consistent monthly payments make it an attractive option for those seeking high yields. When it comes to performance, TLTW provided an interesting twist in 2024. While long-term Treasury bonds, represented by TLT, faced volatility in 2024 due to rising interest rates, TLTW's covered call strategy helped offset some of the declines. In 2024, the total return for TLTW was negative 2%, compared to a return of minus 7.8% for TLT. TLTW's option writing strategy may limit upside potential in falling rate environments, but provides additional income in volatile or rising rate markets. So if you are looking to speculate on interest rates, the underlying ETF, TLT, is probably a better choice, especially if you are comfortable with supplementing income with options. However, although there are no options available for TLTW, if passive income is your game, this ETF could be a sound option. Now, let's turn our attention to SRLN, the SPDR Blackstone Senior Loan ETF. If you're seeking income with a floating rate component that can benefit from rising interest rates, SRLN is a fund you'll want to learn about. Let's dive in and explore how this ETF works and why it might fit into your portfolio. SRLN is designed to provide income by investing in senior secured loans. These loans are issued by corporations and rank higher in the capital structure, meaning they are among the first to be repaid in the event of a default. What makes SRLN unique is its floating rate structure. Unlike traditional fixed income securities, the interest payments on these loans adjust with changes in benchmark rates, such as LIBOR or SOFR. This makes SRLN particularly attractive in rising rate environments, where its income potential increases alongside interest rates. Let's look at the details. SLRN launched on April 3, 2013, giving it a long track record of performance. It currently manages over $4.5 billion and has an expense ratio of 0.70%. In 2024, SLRN paid $3.82 per share in monthly dividends, representing a 9.1% return. The total return for 2024, including price changes, was slightly lower at 8.6%. These figures demonstrate resilience in a volatile interest rate environment. While fixed income securities like long-term bonds face challenges, SLRN's floating rate structure allowed it to deliver stable returns. SLRN holds a diverse portfolio of senior loans across multiple sectors, including healthcare, technology, and consumer discretionary. This diversification helps to spread risk, though it remains concentrated in corporate credit. The nature of these holdings can highlight certain risks, including credit risk, where defaults or credit downgrades can impact returns. Additionally, these holdings are less liquid than traditional bonds, which can affect the fund's ability to buy or sell efficiently. In summary, SRLN offers a unique way to generate income while staying protected against rising interest rates. With its focus on senior loans, floating rate income, and strong performance history, it could be a valuable tool for investors seeking flexibility and stability in their portfolios. Hi there! If you've managed to stick with me this far and found this material valuable, please like the video and subscribe to the channel. It's a big help. Let's explore BITO, the ProShares Bitcoin Strategy ETF. This fund is one of the simplest ways for investors to gain exposure to Bitcoin without needing to directly hold the cryptocurrency. Let me break down how it works and why it might be worth considering for your portfolio. BITO doesn't invest in Bitcoin directly. Instead, it seeks to track the performance of Bitcoin by investing in Bitcoin futures contracts. These are regulated contracts traded on the Chicago Mercantile Exchange, CME, and they allow investors to gain exposure to Bitcoin's price movements without dealing with the complexities of storage or security. This makes BITO a convenient option for investors who want to participate in Bitcoin's performance while avoiding the risks and technical hurdles of holding the actual cryptocurrency. BITO was launched in October 2021 and was the first Bitcoin futures ETF approved in the United States. It has around $1.3 billion under management, and the fund charges 0.95% fee, which is on the higher side. Bitcoin is known for its extreme price volatility, and BITO reflects these swings. While it doesn't track Bitcoin's price perfectly due to futures roll costs, BITO still provides a relatively close approximation of Bitcoin's performance. As mentioned, BITO trades Bitcoin futures to gain its Bitcoin exposure, but also holds $1.4 billion in U.S. Treasury bills, providing current income. Dividends are paid monthly through earnings on U.S. Treasury bills, as well as from gains on futures contracts. The returns over the past 2 years have been extraordinary. In 2023, BITO paid $3.10 in dividends, 29.7% on the starting price. In 2024, it was even better, paying $13.03 in dividends, or approximately 63.6%. Overall returns were also eye-popping. Considering dividends and capital appreciation, BITO showed a return of 126.2% in 2023 and 74.8% in 2024. Of course, this investment yield is not typical, and past performance is not an indication of future returns. However, Bitcoin appears poised to continue its acceptance as a store of value. While figures range, it is thought that 8% to as high as 17% of adults in the U.S. own Bitcoin. As time has passed, it does seem more and more like Bitcoin, and by extension, BITO are here to stay. For you options traders out there, one of the most exciting things about BITO is its large and liquid options market. These options can be used in any number of strategies: covered calls, put selling, or even hedging strategies. The options market here can really add value. There are several of risks associated with this ETF, including high volatility, liquidity of cryptocurrency markets, as well as the cost of rolling futures, also known as contango decay. Risks aside, the prospect earning real monthly income together with participating in Bitcoin can be very attractive, and I believe this ETF should be considered as part of an investment portfolio. Well, there they are. Today we've explored a portfolio of 8 powerful ETFs that demonstrate the potential to earn over 10% yields, offering a blend of high income, diversification, and exposure to unique asset classes. Let's quickly summarize what we've covered and how these ETFs fit together. Diversification is a key strength of this portfolio. Let's break it down. Funds like JEPQ, XYLD, and RYLD provide exposure to some of the largest and most innovative companies while generating consistent income through covered call strategies. Newcomers like QDTE and XDTE have produced excellent results with their weekly dividends using zero DTE strategies. With TLTW, you get exposure to U.S. Treasury bonds paired with a covered call strategy to boost income, while SLRN focuses on senior loans with floating rate exposure, providing stability and protection against rising interest rates. Bito gives you an innovative way to gain exposure to Bitcoin futures, allowing you to participate in the cryptocurrency market within a regulated framework. In summary, these 8 ETFs offer a unique opportunity to build a portfolio capable of delivering consistent yields above 10% while maintaining diversification across equities, bonds, and even cryptocurrency. As always, remember that every investor's goals and risk tolerance are different. The information presented in this video is for educational purposes and should not be considered financial advice. Be sure to evaluate how these securities align with your financial needs and consult with a professional if needed. If you have any questions or if you know of any other ETFs that I should have considered, please leave a comment below. Thank you for watching. Until next time, good luck out there.